what I've always found very funny about our industry is because it is one of the oldest industries in the world, we've had hundreds of years of bad processes and antiquated systems to just keep adding on to what we're doing. And so you just have this Jenga tower of room for disruption.
Hi, I'm Gordon Lamphere, and welcome to the Real Finds Podcast, where we have real conversations with key entrepreneurs, activists, and researchers who are shaping the real estate industry and, as a result, our world. On today's podcast, we have Lisa Holt from Ivy Risk. She provides us deep insight into the world of real estate development insurance. Today, we discuss tips and tricks on how to lower your insurance costs, the growth of AI in the insurance industry, and what developers need to watch out for going into 2027. If you're a real estate developer or investor, today's podcast is well worth a listen.
Why real estate? Why insurance? Like into the
Yeah.
yeah.
I did not know the why for insurance when I started out in it. And then I found the why for real estate afterwards. But in short, insurance has fit my character profile so well. It is just a playground for curiosity. There's no end to what you can do in insurance. Pick any industry, and this is what I'm telling my kids, and this is what I'm telling people that might be looking at either even a career change or they're starting out in their careers. Insurance allows you to pick and choose in the areas that you find so much interest in. And so for me, I naturally gravitated towards real estate and development. The idea of something having so much longevity and really creating the world that we live in from a development perspective and the responsibility that comes with it, I think it's incredible. And then on top of it, being able to see what it takes for something that requires so much tenacity and so much resilience to make things happen in the real estate world. You know, I mean, just to close on a deal, a transaction, an acquisition, a development, I mean, it could be a decade plus in the making. And I find that so incredible that you're working with people that have that long-term vision.
So your niche is somewhat unique in the insurance world.
Yes.
Insurance is a pretty broad topic and pretty broad industry. I have friends that are doing maritime insurance and are worried about the Strait of Hormuz right now. And then I have friends that are, insurance that insure agriculture and all various different things. So I'm curious, what is your niche in the insurance business, and how do you help folks in the real estate world?
I'm glad you brought that up because insurance is such a big world. And I've used the analogy a few times. I'm still perfecting it, but as a Christmas tree, and say the star on the top is just insurance. And then you start moving down and you have commercial, personal lines, health and wellness and benefits. And then you keep going down, and I'm going to just veer into the commercial space, which is where I play. It's different industry classes. We have different product lines. Where I'm specific and specializing is real estate development. And what's unique about it is when I started my brokerage, I made the decision. I remember putting so much thought into this. I felt that it was a very important and critical decision and a differentiator to say, you know what, we're not going to do any other type of risks. And I don't know any other brokerage that does what we do in the sense of we only write commercial real estate owners and developers. We have certain minimums, and we'll base it off of either the construction value of the development or say the portfolio value. But overall, that's what a decision I made, because I think it requires a certain dedication and exclusivity to this type of risk in order to be the best. And that was something that I didn't want to stop until we achieved.
What makes developers' risk unique versus any other sort of commercial real estate risk?
What I love about a development risk is you are selling something that isn't there, right? You're selling an idea. There's so many factors. At least if I bring a an actual building, a permanent placement to a carrier. I can say, you can go see it for yourself. You can go touch the walls, right? Like there's appraisals, there's lots that I can provide them. When it comes to a development risk, I'm selling a promise that it's going to get done. So in the terms of, let's call it, if it's a condo development, I usually love to get my developers to purchase escrow deposit bonds, which allows them to use the buyer deposits towards the cost of construction. Well, in that sense, it's a credit risk, right? The carriers want to make sure that these developments are going to get done, or else they're really losing out. Now, that type of product line is a lot safer. It has a lower loss history, but when there is a loss, it's catastrophic. Then you have on the builder's risk side, which is your property. There's so many variables from and these are things that people don't think about. I had a very large project once that essentially we had to draw a halo around the property to make sure that the equipment they were storing off site or any of the product, it was within 1,000 feet of the proximity of the location, but it actually wasn't on the location site that was being insured. So those are all the dynamics that really are important to get the underwriters to understand what they're looking at and really tell the story in a way that minimizes any concerns that they may have and really represents your clients in the best light.
So, one of the things that my clients have been talking to me about tremendous amount in the last 5 years is insurance rates. And I know that we're going to have a lot of listeners on the podcast who are going to have similar gripes. So my insurance is skyrocketing, it's compressing my ROI. What are you seeing in terms of insurance rate trajectories as we get into 2026 and kind of look ahead into 2027?
Insurance rates have been a spectacular topic over the last 5 years, not for the right reasons. But I will say I'm in my 12th year of this industry. And I know what I had been told historically when I first started about just insurance rates. I started during a very soft market when it came to the property. The liability was following. So it was very easy to kind of jump right in and let's compete. And I kind of learned in that sense. And then as the market started to turn, and all of a sudden I got to take all of that experience and get creative. And that's where it really separates the more sophisticated brokers from maybe the ones that are checking boxes or just filling out some paperwork. So it was a perfect progression for my learning style. And what has been interesting is from what I've learned historically, let's call it over the past 50 years, it really does tend to follow market conditions. It's a supply and demand type of product. So you really can't determine what it's going to look like, but you can follow a certain trend and it's cyclical, right? These last 5 years was the first time that I've seen, and I think anyone that has been in this business that's alive to say it, has seen such a drastic shift in such a short and compressed time frame. That's what's been crazy. I was actually, as I was thinking about our podcast leading up to today, first, I had a little chuckle to myself that I almost feel like the insurance market has followed our politics, our political landscape. It's just everything's kind of crazy right now. I don't know what's happening with the world. But it is interesting to watch how the insurance market is doing things that have not happened in the past. And it does go in line, and who knows correlation, causation, but there's involvement with where the climate change has taken us. For example, we're looking at convective storms. They used to account for, I think it was the per event cost was 30% lower about 10 years ago. And now it's just a new normal on what that average cost of convective storms are. And that's something that we didn't even discuss 10 years ago. You're looking at even wildfire that accounted for 1% of global losses in total. And now it's accounting for 7%. So there's so many shifts and changes, and people don't realize that it has to do with the entire global landscape and not just what's happening in their backyard, which in turn I understand causes a lot of pain points, because then when it's saying I get the increase, but it doesn't have to do with me or my risk. It can be incredibly frustrating. So that's where the insurance buyers need to take advantage and take control of their program so that they're not being reactive to the markets and they're actually proactive and they stay in the driver's seat.
So, one of the very few things that we can control is what risks we want to take on. So, I'm curious, what kind of risks and risk profile are you seeing for various asset classes? Like, are there certain asset classes that haven't seen spikes or things are leveling off a lot faster? And are there certain asset classes in the real estate world for either developers or owners that our listeners should be particularly, you know, concerned about?
It's funny. I recently heard someone speak, just giving a little brief intro on insurance, and one of the comments was, um, with general liability, they're really concerned about foot traffic, so try not to purchase retail properties. And I felt like that was such a simplistic version of what's really happening. So I would never say that, stay away from certain asset classes because there's obviously so many other things that go into that. But from an insurance perspective, if I got my pick, there's definitely been some challenges when it comes to multifamily. They have been hit the hardest, unfortunately, especially on the development side. But that's the nature of that risk, right? You have a lot of different tenants that are in there, a lot of foot traffic. The liability can be pretty great in that type of asset class. But overall, they all do look at, when it comes to the carriers and underwriters, they're looking at tenant profile, occupancy type, construction type of the building. And if I had to say one thing that can be the most important part of your role as an insurance buyer, it's to select a broker that you trust and then be very transparent and provide as much information as possible. And it's going to be up to that broker to analyze and really digest that information in a way that is going to be the most palatable for the carrier and underwriter, and for the broker to understand what they're going to be looking for and what's important and what the client is giving you. I've come across too many situations where the clients don't understand what is needed or why it's needed. And I find that once that education piece is added and you're able to explain the importance of why you're asking for what you need, it changes the entire process.
So, how are brokers and then as a result, underwriters underwriting today? There's more data than ever before. And like, what generally are they looking for, and kind of how has that process changed for somebody who might be a user or a developer or an owner who has worked with insurance in the past, but now it seems like there's a lot of additional requirements and things that people are involved in looking at from the insurance side, even over the last like 10 years.
Absolutely. Data and analytics have become such a major part of what we do. Y- I strongly believe that if, again, you have the right broker that you have involved at the very beginning of whatever process, whether it's development, due diligence on a potential acquisition, there's so many pieces that we can provide value with the data and analytics that we have available. So typically, when you go to get a policy or a quote, the carrier is going to have their own modeling, and that is notoriously a black box. It's not something that we get to see. They just spit out some information back to us and case closed, right? So by taking that power back as brokers, and what I've done is I've formed partnerships with much larger national global agencies as well, because again, the data is key. And so what we're doing is we're coming in early, whether that's on the lender requirement side and helping, again, educate the lenders and what they're looking for and what they're asking for, and really helping them to form what those requirements should look like so that everyone is protected. And then also, it's been interesting to see on the carrier side, because when you are providing this information, what it's doing is it's turning what we usually saw insurance as a historical look back, right? We would say, well, we've had X amount of hurricanes and this amount of catastrophic losses over the years. So we're going to predict that moving forward, 1 + 1 = 2. Now they're looking at these forecasting models that allow you to really manipulate so many different scenarios and identify even critical key points of certain locations. Say you have a large portfolio, we can do such a specific dive into your portfolio that says if you make these capital improvements on your locations in zip code dot dot dot, and then you also do some water mitigation in those residential units that you have in this location, these are the returns that we could be looking at and seeing. So, or these are what we can discuss with the lenders about minimizing or lowering the requirements or doing away with entirely. So it's a very strategic process that can be so involved in a sense that really makes you feel like, okay, now I am actually paying for something that makes sense. And I'm so educated and understanding of what that looks like and why I'm spending the dollars that I'm spending, that it creates a much less frustrating process, if you will. And what I like to say, sometimes pleasant.
So it'd be wonderful to have, having the change process and improving a property be a pleasant process, but it definitely costs money. And there's a lot of individuals that on here that would like to make changes, but they want to get bang for their buck. So I'm curious, where in particular do you see some of the biggest gains being made for individuals who want to improve a property to limit risk and reduce liability, that they can really maximize that property improvement?
I think the first thing is the mindset of what that process will look like. It is a long-term play. Nothing is going to happen from one renewal to the next. Now, in terms of where your current insurance program might be, there are a lot of programs I take over that I'm able to drastically improve, whether it's from a premium savings perspective, enhanced coverage, terms, conditions. But if you are already in a good place, that might be a little bit more difficult to improve upon unless you're trying to change the entire structure of the program or if you're looking at taking on more risk. And so we usually start with what's your risk appetite? When it comes to at my house, I have a huge tolerance for risk, and my husband likes to purchase as much insurance as possible. So, there's different buyers out there. So it's first understanding what they're looking for and what they're comfortable with, right? Then you want to know, how much do you want to understand about this process? I like to give them the small, medium, and large versions. And sometimes you have clients that want to dive in and they want to know all aspects. And there are some that say, you know what, I'm going to really just put this in your hands and I need the highlights to understand how I make the best business decisions internally. It's really one of those things that if you make the decision to do it right, you will find the results and you get to pick the savings or the enhanced coverages. One of the accounts I'm working on right now, while I can produce a ton of savings, they also have a lot of exposed buildings and locations that don't have coverage. So we're going to analyze that and I'm going to give them different opportunities and options that allow them to say, okay, I'm going to actually enhance coverage right now. And what my recommendation at this moment, because of where the property market is buy more, because that is going to change. And we are at an event right now where property rates have come down so quickly and so drastically that this is the time to do it. And that way, when the market starts to shift again, which it will, you have things that you can let go of. You can say to your carrier, okay, fine, I'll let you have, a certain limit here, or I'll let you raise this deductible there. Those are the things you want to kind of put in your pocket and be ready for. So again, it's a long-term outlook, and it's saying, I am going to dedicate myself to this risk management program, and I'm looking at it in, call it 5-year cycles. And I want to make sure that I'm giving it the attention that it deserves to make sure that nothing falls through the cracks and I'm not caught by surprise, which unfortunately is what's happening to the majority of buyers out there right now.
So That's interesting to hear you mention rates coming down. So, for the last 5 or even 10 years, all I hear about from our users is rates are going up, 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 and it's a borderline panic in some cases. Um, where are you seeing rates coming down, and why do you think that is?
Yeah, so that's a great delineation. Each product line does its own thing. Carriers have different risk appetites themselves. They'll pick different areas that they want to focus in. So it's like gambling. I love saying this and using this analogy because I like blackjack. You might be a poker player, right? And I might see a lot of wins that night and you might not do so well, but then the next day the luck turns. It can be the same thing in a policy term. If you're AIG and I'm Chubb, and I love residential. I'm the leading player in personal lines, and you happen to be doing a lot in the environmental space, and that's where you've been finding so much traction. Neither one of us is right or wrong, but depending on how those industries perform, we might not be at the same place at the end of the year, right? So it's important to look at your risk management program. When people say my insurance is going up, I want to say, well, what parts, where, right? So auto has been difficult since I've been in the business. That has been a trend that has not really given relief at all. And I happen to live in South Florida, so we also have to speak about geography, right? So the Midwest, where we haven't had as many natural catastrophic disasters, but like I mentioned the statistic earlier, the convective storms have increased, right? And so the risks do change, but they are specific to geography, the type of asset class, and ultimately it's something that if you're looking at it from property, which is usually the driver for a lot of insurance buyers, I don't know if that's maybe what you've been hearing so much on because we did have a lot of softening prior to 2019. And then it started to harden and probably 21 to 23, it was a bloodbath. I mean, there were people that were having to go back and renegotiate contracts because there literally was not, it would have put them out of business to purchase the insurance they were requiring. Now, I have heard of stories from 30, 40 years ago that people couldn't even find the coverage, let alone have it at a higher cost. So I think there have been worse times. But when you have clients and people that are getting 100, 200% increases on their property alone, that can destroy a business very quickly. So we went from that, what I just described, to steep decreases. We're still looking at probably double digit decreases even now going into 2026. And what I love to explain to people about insurance is we have the flow of capital is really what is going to dictate in many ways how strong the property insurance market is. So we have money that's coming in from really all sides of capital investments. But what's been increasing over the last few years is the insurance linked securities. And so those are really a financial instrument that allows insurance companies to transfer risk to capital market investors. So they're saying, hey, will offer, a cat bond and you can purchase it and they can be very specific. So these hedge funds get to diversify their risks. They can say, I'm going to bet that South Florida, again, we're back to gambling. I'm going to bet that South Florida is not going to have any hurricanes for the next 12 months, right? The returns can be very high on those types of cat bonds. And because that type of investment has become so big that has added a lot of capital into the reinsurance marketplace, that comes down into the guaranteed cost carriers that most people are buying from. And so the savings just keep trickling down. And it's for reasons that people aren't really thinking about. And when you do take a step back and you look at the whole world that it encompasses and how it's layered into the fabric of everything that we do, you're all of a sudden thinking from a place of curiosity and interest that it's like, that sucks that my premiums just went up by that much, but it's pretty cool to think about why.
So, when we're taking bets, are there solid bets that we could take as either developers or users or investors to kind of look at creative ways that we can structure and kind of limit risk on our end. Are there methods that we can do?
It's in the same way that you identified that different product lines are going to be experiencing different types of pricing, pushes. It's the same when it comes to the type of risk or the type of buyer. So you might have more of a small market, insurance purchaser that they may not have a lot of options because it's a smaller general liability policy or a smaller property policy. Maybe they don't have a huge portfolio. And in those cases, you are kind of placed into a limited area of options. So again, it goes back to your broker. Hopefully you can find a broker that you really trust. But when you're dealing with the larger, more middle to large market type of real estate owners, investors, and developers, the options are endless. The creativity and innovation that is out there and continues to grow. We're looking at alternative risks. That's my favorite space. It's about how can we deploy capital and really have an alternative risk financing strategy that we're saying we're going to put money into this and we're going to see it grow. We're going to manage our safety program and our risk management program so that we don't have a lot of losses, because there are ways that you can take control of that as well. And we're going to have the money just be returned to us. And what I'm describing essentially is what we call a captive. And that's when companies have either the scale or the capital to put up where they say, I don't need you, Mr. Insurance Company or Mrs. Insurance Company. I'm going to form my own and I'm going to take on the risk. I've had excellent losses for the past 5+ years. And I feel comfortable in knowing that this is a gamble I'm ready to take on myself. And when that happens, the success stories are incredible. I have clients that get annual dividend checks for, 6 figures plus, and it's always really exciting.
So, what's the kind of client that meets that profile that kind of a policy would work for in particular?
So you do want someone that has a dedication to their risk management program. The implementation of something like that can be a little bit more tedious on the front end. They need to have There need to be either liquid or access to capital. They can put up letters of credit, because if you think about it, you're building up a bank that can essentially insure your insurance company. Now, there are options where you can go and get reinsurance and you can kind of have a backstop, right, for more severity type claims versus frequency. But essentially, you want to have enough in premium spend. And if I had to just throw out one number, and we have a saying in the captive world, if you've seen one captive, you've seen one captive, because they can be structured so differently on an individual basis. But from the larger scale, you'll have a single parent captive, but there are options for smaller companies where you can do more group captives, where you combine your risk with other members. And that way you're able to kind of spread out the cost to implement that captive. And you're really just joining one that's already in existence. So it's not to say that it's only for people with a lot of insurance spend, but we usually like to start at around 2.5 to 3 million in their total cost of risk. So it sounds like a lot, but you're taking into account everything they spend on insurance, whether it's a deductible, whether it's a claim they had to pay out. It really encompasses everything, because the captive allows you to manage so many areas that a guaranteed cost policy that we all usually are buying does not.
When we talk about explaining risk, uh, a lot of risk that we see now is the big discussion is on geography. And I know we've touched on issues like climate change and hurricane risk. Are there certain geographic and asset class arbitrages that particularly you're seeing in terms of geographic presence, and like are risk takers and the insurance industry looking at regions in particular as more risky or less risky, And like, what would you say is the most risky area in the United States right now? And then maybe we could discuss the least risky as well.
So I'm probably sitting in the most risky from the eyes of insurance carrier in Florida. If you think about it, we're surrounded by three bodies of water. You were just sticking right out there into the Atlantic, a lot of flat land. So obviously, hurricanes and windstorms are just so prevalent. So immediately, anyone buying insurance in Florida, especially South Florida, you're automatically paying at least 25% more. Like that's just a done deal, right? And that's in terms of auto. So their insurance carriers are very aware of the difference in geographies. From an auto perspective, I mean, the rates that we have to pay down here, both commercial and personal, are astronomical. And if you go on our roads, you will immediately understand why. There's You don't need to explain that one.
Like my brother has lived in Miami for a very long time, and I remember going down and telling me about not using your turn signal too early. And the Midwest, that like it's not something we ever worry about. So
Right.
I, it, in terms of things that we do worry about though on the podcast, one of the biggest things is we try to speak to the men and women in the arena to try to learn more about things we might be missing, and that's kind of the whole point of the podcast is to uh, get more in-depth knowledge that would be kind of outside of our immediate realm. And what do you think that there's one topic that the real estate industry isn't talking enough about in the regarding insurance? Because I think that real estate in general is missing a lot in terms of insurance, particularly from the real estate perspective.
Yeah. Yeah. I don't know if I would say that might also have something to do with the fact that up until 5 years ago, we weren't, well, we're actually very unpopular at the moment and have been, but we weren't even thought of prior to this recent cycle. So, yeah, the real estate industry has a lot to catch up on. And it's if I had to pick, let's say, just a few things that your listeners could take away from someone that does this every day, there's so many things that they can do from their end just from the very beginning. And one of them that I've noticed in the industry, because say when you want to make capital improvements or you want to develop something, what are you doing? You're bidding the work, right? That's just the nature of how you handle the process. But that's not the case in insurance. So the number one thing I would say is you pick the right broker and you say, this is going to be the person that I want to handle my risk management program. Then also, I mentioned this earlier, is giving as much information as possible. That's only going to help your case, assuming you have the right broker that knows what to do with it. You did mention before on just different asset classes. One thing to keep in mind if you are out there and you're active in acquiring new properties or even selling off, what we do look at is the program holistically. And if you have different construction types or different ages that your buildings were built, usually it can help to offset maybe some of the older buildings and less, favorable risks with some newer products. It really can vary, but that is something to keep in mind just immediately off the bat. If you're touring properties and you see that it's dilapidated and there's a lot of room for improvement, you can automatically tell yourself, all right, insurance isn't going to be pretty on this. And that's a pretty easy connection to make that I think is really important for people just as they're out there looking at different opportunities and seeing, does this make sense for my business?
Yeah, I, I know we've certainly been on tour recently on a number of portfolios that people are looking at either reevaluating their management and or to sell. And one of them, they were ranting about, oh, our insurance rates are so high, and I'm driving around and I'm like, I know why your insurance rates are so high. It's because
Right?
you're poorly managing your properties. Um, I, I think there are plenty of things like that you can easily tell, where things are going, and I think things are going towards, at least on our end, more of a on hands-on management style to reduce things like insurance rates, and the world is so data driven. I'm curious from your end where you see things going in insurance 10 years down the road. Where should we see the industry going, and kind of potentially how can then the end user of insurance react to
Oh, it's such a loaded question because my immediate response is I'm terrified. But then I,
it?
I sit back for a minute. I'm like, no, it's really just the unknown. And we're going to go back to the AI conversation. I know it's AI is an ongoing topic for a reason, right? And what I've always found very funny about our industry is because it is one of the oldest industries in the world. We've had hundreds of years of bad processes and antiquated systems to just keep adding on to what we're doing. And so you just have this Jenga tower of room for disruption. And so I'm very excited about that. But again, when you are in an industry that I think everywhere you turn, there is somewhere that you can make drastic improvements and changes, it makes you worry. So if you're ahead of it, I can't say in the next 10 years, but I think the way we do things is going to be obsolete. I don't know how we can continue with the antiquated process that we do things right now. And even as we're talking, when we hang up here, I go back to a manual spreadsheet analyzing a risk that I know there's systems out there already that can do what I need to do. It's just a matter of how long will it take for them to become user friendly, and where will that take us from there, and what will what impact will that have on our roles as insurance brokers? What impact will that have on insurance carriers? I just finished a demo on an AI system that's coming out of Lloyd's lab in London. And they're taking basically for insurance carriers, they're able to analyze and connect all of the different policy language that they have so they can say, hey, we're seeing a series of losses in this specific, call it geography, asset class, or a specific type of loss that's happening. Let's analyze where we have that exposure in our policy language and figure out how we can close that gap. When I hear something like that, on the one hand, my brain immediately thinks, okay, great. So insurance carriers can become more tight on, they can become tighter on what they're looking for in their requirements, which means they can manage the risk better, which means they can hopefully have better rates and savings. But then it also tells me, okay, if they're able to identify all the areas that would give exposure to them, that means that it's the buyers that are being closed out of that opportunity to recoup on a loss. Right? So,
Yeah, I, I I think it goes to this, and it's something that we see consistently now. So I know we have two members of our team that are just basically using Claude and ChatGPT every day, and we're developing all these new algorithms and programs on our team, not just to manage properties, which is primarily probably 60% of what it is, but another 40% to improve things in terms of uh, evaluating properties on a variety of factors. But what I think people underestimate too is like that world that we often hear Elon Musk and Peter Thiel discussing with AI is this whole idea that, that assumes that you have all the data. And I still think that there will be huge gaps. AI isn't God. And so, as a result, you'll see these gaps in the market. And there always will be arbitrage that will come to somebody who's walking the site and really fully understands the ins and outs of a property. But I think margins will get a lot tighter, particularly for the consumer, just because of everybody we've been talking to.
yeah.
Um,
I did just hear a statistic. Sorry, on that note, is it was, I mean, I guess it's just going hand in hand with what you were saying. Like there are these different systems and tools that they can now deploy that have savings, but then there's also people that don't have those jobs anymore because of it. So yeah, it'll be interesting to see where that goes.
yeah, will be really interesting. One of the things that we find that's particularly interesting is we have a number of younger listeners on the podcast. And what advice would you give to a young Lisa that was just starting off in the industry? If you could just sit down for 1 minute and give her a chat.
I love this question. Um, I love this question. And of course, I thought through so many different critical pieces of information that I could give to young Lisa or any young person out there. And the number one thing I just keep going back to is the majority of people don't know shit. They don't know shit about shit. Like, am I allowed to say that?
Yes.
Like, okay.
Yes. Yeah.
It is incredible. And I've lived my life with such high expectations of myself that it has almost created this cycle of this loop of thinking that maybe people know something that I might not. And 98% of the time they do not, but they will speak as if they do. And I've found that to be very interesting. And my number one thing is just don't let that impact your own way of thinking. However strong or with conviction someone's saying something should not influence how you're interpreting it. It's really about the words and understanding what is really being said and having the confidence that as a younger person, you're just as smart as the veteran of 30 years in the industry. The only thing you're lacking is the experience, which is going to come. So there's so much value in the younger generations coming in that I love to see what they're going to do with this and what we can learn because it's such a two-way street.
Yeah, you got to have faith and trust yourself. One of the things that we do trust is that you do have uh, hopefully an individual that we should reach out to. We find that the men and women in the arena, they truly know who are the best voices to talk to in the industry. And one of the whole reasons for the podcast is to get connected with those folks. So who's the next person that we should have on the podcast?
So I gave this a lot of thought as well. And I was like, would she take this as, I don't know if she does podcasts, but when I talk about alternative risks and I talk about captives, one of the largest captive managers in the world, the person who started that company is recently nearing retirement, and it's a woman, and it's an amazing woman. Her name is Jennifer Gallagher, and it's incredible what she's done and where she's taken this area of the industry. And so I would love to reach out to her and see if that's something that she'd be interested in. But the more that I can communicate to insurance buyers that there is another way to do it to where it's not just a sunk cost and you're actually leveraging your risk in a way that can be an asset, it's a game changer. So yeah, Jenny Gallagher, she's been with Artex. She's been incredible. And any woman in insurance. The first female insurance broker didn't come about until 1973. Yeah. It's pretty cool to see how far it's gone.
It's wild. In terms of the connection, we would love the connection to Jenny. There's one thing though that will be our last question today is if somebody wants to connect with you, what's the best way to get in contact?
The easiest way is either my Instagram at Ivy Risk Official, my website, ivyrisk.com. So IVYRISK. And my email is Lisa at Ivy Risk.
Lisa, thank you so much for hopping on the podcast today, and we have to have you on in the future.
I'd love that. Thank you so much, Gordon.
Thanks again to Lisa. We appreciate her insights. And if you enjoyed the podcast, please give us a like, a 5-star rating, and a review. Your comments, interactions, and subscriptions truly matter and help us continue to get quality guests. You can find us on YouTube, Spotify, or wherever you get your podcasts. I'm Gordon Lamphere with the Real Finance Podcast. Thank you for listening.